Hi, everyone, and welcome back to another show. I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about different types of options trading strategies and figure out which one is the best for you. Matt, do you want to share a screen and get us started by going over our current positions?
Absolutely. All right, so we had an NVIDIA trade, short risk reversal, which is basically we buy the put and sell the call. We did that for 26 cents of credit. It went against us $3.50, we'll say, but our stock went up $10. So we're doing good in that NVIDIA. So we have the protection. And we're short the call. We're short the call at 142, so we still have a lot of room in that 117-day collar that we have on. So it's the risk reversal, short risk reversal, or collar. Very good way to protect your concentrated positions, or if you have a lot of stock in a certain name. We also did a hard to borrow trade, one of our first ones here, where we basically did a combo where you sell the calls and buy the puts on the same strike. So that's basically 100 deltas negative, and then you buy 100 deltas. And what you're hoping is that in put call parity, you just have buying the call with the strike minus the puts equals the stock price, and the only thing left is the borrow rate. So we wanted the borrow rate to get harder to borrow, but it looks like it's, we're kind of just breaking even there. So there's not much going on there, but it's an interesting trade to do just a pure, isolate your alpha, which is we thought the alpha that we thought was that even though Trump DJT was hard to borrow, we thought it might get even more hard to borrow with more people trying to sell it. And then that would go in our favor. But so far, nothing much happening there. So those are our trades, Tyler.
Great. Thanks, Matt. So this week, we're going to be looking at different types of options trading strategies and helping you figure out which one is the best for you. There's a lot to cover. We're going to go over different types of risks and types of trades that you can do. I'll let you get into it, Matt.
Yeah. So, I've seen a lot of comments. I read the blogs and posts and such Reddits about, people just seem to be, trying to find trading strategies, and then they trade them for a while, and then, it may or may not work. And then some people get frustrated and all that. So I wanted to go and just take a broad brush on, creating your own option strategy. Now, of course, there are many people watching and you're all different. So this is just going to be a general approach, and obviously not specific to, you need to consider a lot of personal things for you. And a lot of the things that you should consider is, what's the size of your trading account? What is your risk tolerance? Is this a small account that you could just play with, or is this a small account that's very important to you? Is it a large account with the same considerations? What are your goals? I mean, you should think about those very carefully before you start trading, and then try to set up a trading strategy that will help you accomplish those goals. And so you would ask yourself, okay, what is my risk tolerance? If it's very high, then you might do some type of a trade where you get the short premium, and so it can go against you. I always suggest that you have flat units at least. So what that means is never be naked short a call or naked short a put. It could be very far out of money, but even with a strangle, you want to have something small, I think, a ways away, just to, in case the worst happens, to protect yourself, to have something manageable that you can afford to lose. So that's the first consideration. Now, if you are, not very risky, if you're risk averse, then you might want to try other types of strategies. For example, if you I had a conversation this weekend with someone that owned stock and then would just sell calls against it. Well, I suggested, well, maybe you might sell calls against it, but also buy puts against that. And if you still want to get income, maybe you could buy puts that are out of the money. So this gentleman was getting about 2% a year on selling calls on a large portfolio. It was a dividend paying stock, about 4%. So he was getting 6%, and also was able to sell calls far enough where the appreciation would be a pretty good return if it did go up. And I suggested, well, that's great, but what if it goes down? And you could, instead of getting 6% with 4% with the dividends, you could get just 1% and buy a 1% put. So those drain money, but that's a little less risk. And this gentleman was older, so I think he kind of caught on at the end and wanted my card. Of course, I didn't have my card, but this is something that you can start to think about the strategies that you're putting on. So and then if you need ideas for strategies, we have a trade ideas tab in our dashboard product, which is a good way. So we have a neutral. So I'm on the neutral tab right now. So you'll see things like iron condors or put calendars, and those are more, you don't care whether the stock goes up or down necessarily. You care that it stays, or that it behaves the way you want. For example, an iron condor, we'll just click on that one. You want it to stay between 193 and 321, pretty wide range, and you make your dollar or so. For this long put calendar, let's check this out. So this long put calendar, you kind of want it to go down, but not too far. So that's the nature of calendars a lot of times. So, are you good at choosing direction? Or, like, for example, I like to check out certain symbols and see if they're in a channel like that. If they're in a channel like that, if it's tight enough channel, you could, put an iron condor within that channel. This is a pretty wide channel right now in SPY, but so that's, what is your edge? What is your alpha? Why are you better than other people at finding a certain, is it going to a certain way to make money? Is it because you could find under or overvalued stocks better? You're good at earnings trades. You look at sentiment. There's a lot of things that you want to bring to the party, so to speak, to create some edge that you have over everyone else. Otherwise, you're not going to be successful in the market if you don't have any edge. So you're just going to get lucky. And so we want to bring edge to the market. Now, ORATS has a lot of indicators, and we have hundreds of clients that are using all our indicators in various different ways. We don't really ask how they're using them because we don't want to know, because we don't want to share that. So we try to give people hints and the ways that we might use the data, but it's something that you're going to want to develop on your own. And we have a lot of tools for that. So we have our backtester. This happens to be our legacy backtester, which is our custom backtester. So in addition to the trade ideas, we have our normal backtester here, where we've run 181 million strategies, backtests, and over many different stocks. So you could wander through these and start to see what those strategies are and what the returns can be. And also, one of the cool things about this and getting kind of used to how strategies perform is you could see, okay, well, this is an iron condor. I know that. This one's only in the market 52% of the time. Again, I'm just choosing the highest one here. It's a very long days to expiration, but they get out with a stop loss of 75% or a profit of 25%, and they only want to trade when the IV percentile is low and the slope percentile is high. Just this particular stock. You could also go in and say, only show me backtests that are trading when it's in the current environment. So right now the IV percentile is high, so this wouldn't be trading. This wouldn't give you a signal right now. But I'm just showing you this to illustrate what you would look for in a particular strategy. So that only happens 52% of the time. Last year you had a 2.26, which is actually very good because these returns are based on what we call notional, or dividing the profit, but divided by the stock price. You could also look at these in terms of the margin that you pay. So what is this in terms of margin? As a matter of fact, we show the margin returns, and that's right here. So that's 18% margin. So when I clicked on that, it pulled up the graph, and so this is how you see these flat lines. So that's when you're not trading. So you're only trading again when the IV percentile is low, and right now it's high. Slope percentile, which is how high the puts are in implied volatility relative to the calls. So this only tests and only gets in when these two entry triggers hold. So we do a lot of testing with signals like this, and again, that's one of the things that we think gives us some edge. Is like, okay, not a lot of people are looking at these types of entry triggers, and so this might be some good strategies to do when those entry triggers figure like these. Other things that, and then again, you could look at how well these do, changing the percent of capital. This is more of the margin. So I'm going to also go back and say, how does this do during bull markets, and how does it do during bear markets? So this is actually pretty, it's a little unfair because the bear markets aren't usually going to have a low implied volatility, but still, this is a strategy that you may or may not be comfortable with, or you may want to, this is the longer term strategy, so that might not be as interesting to you if you're more of a short-term trader. What is your personality? Do you like to trade a lot, or you like to do this only at certain times when the odds are really in your favor? So I guess the point here, Tyler, is that the backtester could help you set up and develop a trading strategy.
Yeah, the backtester is definitely a great tool for that. I've been thinking a lot about what you said about isolating your alpha, and we've talked about it on previous shows. And this is what ORATS can help you do with a lot of the stock scan templates and option scan templates. Now I've thought about, just from like a trader's perspective, I think when you're choosing a strategy, it's important to think about what you're isolating. So if I'm comfortable isolating theta, right? Like I want to, sell options and I want to isolate my theta and make money off the theta, then what strategies should I be choosing? Same goes for delta or vega. Right? I think you can kind of bucket a lot of traders into these groups, right? Based on their comfort level on what they're trading. Obviously, if you're comfortable, picking a bullish or bearish on a stock, that would be, you want to isolate your delta, right? And you want to leave the theta and vega movement kind of flat line.
Yeah. So what Tyler's talking about is if theta is one. So there's a common trope out there that the implied volatility usually trades at much higher than the historical volatility, and that's how you would make money in a theta game. However, and that used to be a lot more true, but recently, like in SPY, that really isn't that true. if you look at this magenta line, that's the historical volatility. And the implied volatility is the blue line. And to me, it looks pretty close. So there's not much theta edge there. Now, if you wanted to find some of that theta edge that Tyler was talking about, one, you could go in the backtester, but another way to do it is to go in the stock scanner and say, hey, I want to find stocks that have that kind of theta edge. So, I'd like to find stocks with, we'll say high volume. So the volume in here is maybe we'll just say 5,000 contracts over in the name. So that's narrowed down to already from 5,600 symbols to 483 symbols. But we also want to find out where the historical volatility, and we could do a ratio here. So the historical volatility, and we could do long term. So it would be ORHV. Is 1 year on there? No, it's 1,000 days or something. Yeah. So here's 1,000 days. So that's like 5 years. And so then we'll go over the ORIV 1 year, IV 1 year. And let's do the regular year. And we could see what that ratio is, and we'll just display that right now. So we could see that, well, we want the, in your case, Tyler, we want the historical volatility to be well below. So we want it to be like in the 0.80 range. What I like to do is I don't want it too low, because that's kind of a weird scenario. So I'll put the lowest I want is 0.85, and the highest I want is 0.95. We'll just say that. So now we're down to 30 stocks. So now you can start to think about, okay, I don't want a 3x bear. So let's see what the implied volatility is of this particular. We could just say, hey, what is the implied volatility here? So display this. So we don't want these high volatility stocks. So we would say, well, for the 1 year, we want something between probably 15 and if we're going to be selling it, maybe 45 or something. So now we're down to 12 stocks, and EEM is one of them. So now if we look at EEM, and we could save this. So we save this from my scans, and these are the low HV to IV liquid stocks, right? Because it has a lot of trading and not too. So let's look at EEM, and let's look at the trade builder like we were talking about for SPY. So do you see something different about this one, Tyler?
Yeah, it actually looks like that trope you were talking about, where it's lower.
Right. So this would be a stock that you would perhaps do better with this kind of selling strategy here. Only problem is this one's a little bit lower volatility. So then but then again, you might go back and say, well, maybe I want it higher than 15. Maybe I want the implied volatility, at least, 25. And then you have Broadcom, Hewlett Packard, and then you have a certain list of stocks. And sometimes what you do, I'll say this again since I changed it. Then you might go to the option scanner and say, well, why don't you show me the best? This is interesting. No trades in this one. So why don't I bring in these stocks? So I have this weird strategy that I've been testing. I call it the flapper. And I call it the flapper because, and I'll draw a line for you with my drawing tool. So the flapper So if this is IV, or I'm sorry, if this is, what is this? This is profit.
Yeah, we're looking at like a payoff diagram.
Yeah, payoff diagram. So it's a iron condor, which looks like this. But it actually has an extra leg here. So it goes up there. So, not only do you normally, so where you don't want it to end up is like in these areas right here. But if it goes a long way, then you profit, and you profit in this area right here. So, and we could look at one. So here's CVS. Let's just look what that looks like.
So you set this up via a custom option scan, right? So this isn't a typical strategy that you see everywhere.
So this is a flapper. So this is you're right. So ORATS has a couple cool things for those people that want to have some different types of trades. So you could set up with different ratios and different calls and puts, and so you add a custom strategy there. I should also say that this iron condor really isn't an iron condor. This is the backtest of the flapper. So what you do here is you could adjust the ratios for some of these strategies. And so what I'm doing is for the long call, I'm buying 2, selling 1. The selling 1 put, buying 2 puts. And that's how you set it up in the legacy backtester. Again, I'm coining the term flapper. So if you hear it somewhere else, you know where it came from. I've never heard it. So that's again, the flapper is because of the shape. So let's look at some of these other ones. Like I said, sometimes you can make it so you get and this looks a little bit odd, but actually I probably need to add some. So this is the same, so we don't want to do that. So we need to have so these puts. So we need at least. So there needs to be a min-max. Anyway, I don't want to get into it too. It came up because I've been testing this. So, but let's see if we can find a normal one.
Yeah, well, so let's go back to what we're trying to do with these particular stocks, right? What are we trying to isolate?
Yeah, so in this case, you want to isolate selling theta, right? So these are stocks with relatively high volatilities where you could sell some theta. Now, this is a little complicated, but this is types of things you could think about. The reason I did the flapper is because I want to be at least flat units. So what I would do in this is I would trade what I call a flapper that gives you an extra call and an extra put. So then I could go and I could sell an extra call and extra put. And so that's what I'd like to do for today's trade, Tyler. So in Avgo, I'd like to trade do you understand what I'm getting at?
Yeah, I mean, you talk a lot about being flat units for protection purposes, protect against your losses, right?
Right. And so what I'm trying to do is find a strategy that gives me units, because I could buy out of the money strangle, but that's going to cost a lot. With the flapper, it's kind of almost seems like cheating, but you're doing an iron condor and adding wings to it to get your units. So we're actually getting paid to do this. There is some risk here, of course, like in this red area, but generally now that I have the extra unit, so I'm going to go ahead and force this. It's 9 cents. I'll probably give him a couple cents. And so we'll do this one time. So we get a little bit there and we get units. So now what I want to do is I want to go back to the option scanner. And I want to now with these, I'm going to clear all this. And now I want to, with Avgo, AVGO, now I could sell a strangle against that. Where is it? So
why are you selling the strangle against it?
Well, you set up the strategy, Tyler. So you said, hey, I want to isolate theta.
Yeah.
Okay, right. And I want to do it in these stocks where the historical volatility is lower than the implied volatility.
Right.
And then I said, okay, well, let's find a strategy to do that. Right. So that's your kind of overall alpha that you want to isolate. Right.
Got it. Yeah.
So then how do you sell? How do you get theta? Right? You get theta by selling out of the money or by selling options. But the risk is that it goes against you. And so
Right.
that's the dangerous part. So what you want to do is get units, so you're at least flat units. You're still going to have a fair amount of risk, but it's not going to be unlimited risk. So what I kind of came up with is, well, let's use the flapper to get, which is basically a ratio of back spreads, to get long units, and then we could sell those, kind of sell the meat and buy the wings is basically what we're doing here.
Yeah, that was a good explanation. It's very detailed of what we're doing. I think it's a little bit easier to visualize the overlapping of the payoff diagrams, right? And
Yeah.
if you look at the flapper, and we'll be able to see this when we go into our positions and click on all the strategies and combine them. But the
Right.
flapper, you're really only profiting like way out there on the wings, and in the middle, you're pretty flat. So
Well, yeah, you get $5 or something. So
right. So the great part
yeah.
about the short strangle is short strangles make money in that middle tent.
Whoops.
And so when you combine these two, you get in a pretty interesting situation.
Yeah. Sorry, I went crazy there. So here's Broadcom, and again, Broadcom has a lot of times when it's below, but there's also some big moves in Broadcom. But what we want to do is we want to now, find a trade that kind of matches up with, the movement here. So what I want to go back to the option scanner. We're going to do we have a 19-day flapper, so we're protected there. So I want to get a very out of the money. So I want to go down, a very out of the money. I'm going to tighten that. Very out of the money short strangle. And then I've set my rankings. So I want forecast and distribution hedge and reward to risk. So now that we're kind of stretching that out a little bit, right? So I'd actually like to go a little bit farther and go down one more or two more, and then get a very risk averse trade is what I want to put on here. So then the really neat thing is the trade builder you could see, okay, let's go to like 6 months. All right, so it has to go between these two lines. If it finishes between these two lines by this time, we win. If it goes outside, we probably lose. But if it goes way outside with the flapper, we might do okay. So let's put on this trade.
I'm very curious to see what it's going to look like when we overlay all them together and put that on the trade builder.
Right. So let's force that. All right, so then we'll go, and like Tyler said, what we could do is just click on ABGO, and it picks up all of the trades here, and you can see that the flapper is so far out of the money. So we sold the 155 puts, we're long the 140 puts, so that's way down here. So we're not really. It's flattening out the line here. Yeah, so this eventually flattens out if you go much wider, but this is with AVGO at 135 and it's 170. So, that's quite a bit.
Yeah, that would be a big drop.
Exactly.
For what, 19 days out?
Yeah. So, we're within this range, we make a decent amount. And
you're protected in the case of a catastrophic event. Right?
Exactly. There's your flat unit.
Long unit. So yeah, I mean that's what you're talking about, isolating theta right there. I mean that's how you do it.
Right.
Well, cool. Thanks, Matt. That went by quick. We're already at 30 minutes. But yeah, I think it's all about isolating your alpha and finding strategies that are good for you based on your risk tolerance and what you want to isolate, be it delta, vega, or theta, sometimes even rho. You're just looking at what you're comfortable with and what you think you're better at doing, in terms of the market. in your own alpha. So, anything else, Matt?
No, that's well put. Think you have to do research. What are you interested in? And some people are biotech geeks, and you could combine maybe 5 stocks that you're following that are in front of the FDA with maybe like an ORATS looking at unusual volume. Like there's just so many things that you could do, but you want to utilize things that you are good at, bring to the table, and then combine it with so much of the stuff that ORATS has here. Watch your risk, and that's where you isolate your alpha by watching your risk.
Great. Thank you, Matt, for another good show, and thank you, Trader, for hosting. If you guys have any questions, you can reach out at support@orats.com or comment on the video below. We'll see you guys again next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.